Hello, hello. This is Peter Nelson with Nelson Insurance Advisors, and I am here with the man, the myth, the legend, Logan Hertz from Hazeltine LLC. Logan, good to talk to you again.
Hey Peter, how you doing?
I am living the dream, living the dream.
Okay, so this is financial malpractice part 5. Peter, you want to give us a quick intro and then we'll jump right into it.
Well, I'm not going to get into details, but I will give you the intro of, this financial malpractice, this situation that you've been talking about, and I highly encourage everybody to go back and you can watch the first 4 parts of it. Okay. What we're doing here is Logan is taking us through a case, really where this gentleman in retirement, he has a fair amount of assets, and he's done the way I was taught back in 2002, the traditional financial planning way. You should have all these assets in these accounts, but the advisor doesn't want you to touch them. And so, this guy's potentially needing cash value life insurance, potentially needing some long-term care planning. None of that is being done because the financial advisor believes that the market's always going to typically go up majority of the time, and the returns will take care of everything. And as I've said in the past, that is financial malpractice. Just like if you walked into a doctor's office and they didn't do an examination, they just went right in and just started handing out medication, right? We would say that would be they'd be one of two things. They're either committing malpractice or they're a drug dealer, right? So anyways, maybe that's too much of a ramble, but I think that's in a brief summary, that's what we're talking about here, right, Logan?
Yeah, when you cut through all of the supposed financial models and supposed credentials that these guys have, it all boils down to give us all your money and let us keep it forever. And we're all going to put it in quote unquote the market, meaning basically mutual funds and retirement accounts, assets that are not under your control. And that's really what it all boils down to when you dig under it, right? Right. There's not a lot of nuance or sophistication there. So this financial advisor has this 75-year-old, 100% in the market with no plan to get out ever. That's really what it boils down to. It really is that simple. Okay, and so we're recommending some alternatives, and his financial advisor is resisting all of it and basically engaging in a not so subtle form of psychological manipulation of the client. So we've been reading through some of the comments of the financial advisor in an email that I have forwarded to me from the client. So we'll pick up where we left off, and I have not read this in advance. Actually, I don't have time to go through. These comments are just so absurd, and they make me so angry. It would not behoove me to go through them. But for the purposes of educating the audience, we're going through them. So here's what we say. We already have a legacy plan in place, which was confirmed with, I won't mention the name. Proceeding with purchasing a policy would seemingly conflict with this plan. Rather than have assets in individually titled accounts that we are able to transfer between you and your wife, this funnels assets into a joint policy / asset, and I'm not sure how that interacts with this other thing. Okay, I'll just stop there and say we have not come to any sort of final policy design. I can incorporate it any way we want, right? Title it however you want. This is totally flexible. So all this is completely irrelevant. What he's doing is he's taking the policy illustration that the client shared with him, and I guess assuming that that's going to be the final design, when it was very clear, this is just a sample. This is just an example. I haven't gone through the full case design, right? There, so we can change all of that. Not a problem. In terms of tax efficiency, there's a step up in basis at the death of either you or your wife, which subsequently funds the testamentary trust designed to insulate those assets. This allows you to take advantage of some benefits and ideally leave assets for your children. Ideally, leave assets for your children. I guess you left that out. In an ideal scenario, you might want to leave something for your children, but really we don't care about them. I mean, this is estate planning after all and legacy planning, but who cares about your children, right? We're just going to gloss right over that.
I'm so confused on one thing, Logan. Whose plan is this? Is this the financial advisor's plan or the client's plan for his future, right?
Boy, what a great question. Who's in control? Who's making the decisions, right? I don't make decisions for my clients. I arm them with the education necessary and I present solutions, right? And I advise them, but at the end of the day, it's their decision. And I was thinking about this, because I've run across this, Peter. Why is it that a 75-year-old has all of his assets in the market? Like, well, why would he allow himself to be in that situation? And the answer is because the process, quote unquote, that they go through is intended basically, this is sort of my reading of it, it's sort of intended to psychologically manipulate the client. Here's the way it's presented. But I've seen this from clients. Like, this is not me making this up. I've seen this. This is what it boils down to. They sit you down and they ask you, Peter, do you want a low return on your investment or do you want a high return on your investment? And of course, everyone's going to go, well, yeah, I want the highest return possible. Okay, well, that means we're going to put you in the highest risk, most aggressive possible portfolio, right? And we'll show you how that looks, because we're just going to assume it's going to get some ridiculous return like 15%. We're just going to assume it's going to get 15%, right? And I'm sure they have some historicals behind that, but at the end of the day, it's just an assumption, right? And
I don't
that's
know
really
about you, but I was always, my mentor taught me actually that you should never assume anything.
well, and also it's more than that, right? It's like, yeah, Peter, we can put you in these like safe, boring, stodgy investments like whole life, which is for like your grandma. It's just, boring and stodgy and conservative. Or we can put you in this aggressive fund, right? Which is like cool and neat. And you want to be with the cool kids, don't you? Right? That's really what it boils down to. The process they go through, which is supposedly there to make sure people don't get taken advantage of and to make sure there's some suitability, is really intended to manipulate you into the outcome that they want, right? And let's not be naive about this. All of the so-called rules and regulations that are set up are not probably there to protect the consumer. That's probably not why they're there. I mean, maybe to some extent, so yeah, and as an example, so I spoke with this client and I was explaining to him, you can take the money you have at risk in the market. I'm not suggesting this to you. I'm not making a recommendation. I don't do that. But as an example, you could roll it over into a survivorship annuity within guaranteed income that you and your wife cannot outlive, okay? And with a guaranteed return of principal, so you can't lose your principal. And you would get an 8.5% interest rate. You know what his response was? Well, my financial advisor is telling me I'll get a higher return in the market. That's really what it boils down to. And by the way, of course, that's totally ephemeral. It's a promise, right? And it becomes a vicious cycle where you put your money into quote unquote the market because you're promised this great return. When that return doesn't materialize, instead of realizing you made a mistake and pulling the plug, they then double down, right? And say, well, now that the market's down, it's a great, it's going to happen. It's going to happen. It's going to happen, right? It's a form of psychological manipulation. So now they feel like they have to keep pouring more money in to make up for the returns that they didn't get, right?
Yeah, well,
and if you really want to make it an apples to apples comparison, you can't compare a non-guaranteed return to a guaranteed return. So if you look at a whole life policy or an annuity and you want to compare it to money in the market, the only way you can really have an apples to apples comparison is say, let's compare the guaranteed rate of return. What's the guaranteed interest rate you're being paid in this annuity? 8.5%. What's the guaranteed rate, meaning the worst case scenario, if you put your money in the market? And the answer is negative 100%. Right?
no, you're
So
absolutely
we have a
right.
guaranteed 8.5% and an ephemeral promised greater than 8.5%. I don't know what the number was, 10%, 12%. But to me, it's completely irresponsible to be promising your clients double-digit returns. Maybe they happen.
Yeah, but there's also as we've talked about them, we're not going to go over it again, but the sequence of returns. I mean, ladies and gentlemen, in retirement, average rates of return do not matter. It's not my opinion. It's based on mathematical, scientific, and economic facts. It is the sequence of those returns, right?
Yep. And how much income are you getting from it, right? It's all about cash flow, as Robert Kiyosaki says, right?
And here's the other thing, Logan, too. I know right now I'm pouring a pile of money into I'm not going to talk about specific products, but my favorite FIA right now has a guaranteed living withdrawal benefit. And if you need to have a long-term care event, the income payment doubles. So, oh my gosh, now you can help to offset a long-term care benefit, right? So of course, it's nice having guaranteed lifetime income, but then these people don't even realize that there's other stuff included in this. Like, my gosh. And that, by the way, that doesn't even have to go through underwriting. So if you have someone that's unhealthy, or they might not qualify for traditional long-term care. Now, it's funny, this guy that you're talking about, he doesn't think he needs long-term care anyways. So it's,
well, he does. His financial advisor thinks having money in the market is a way of planning for long-term care. Apparently, like we discussed, putting money in quote unquote the market, which, by the way, when they say the market, what they mean is mutual funds in tracking something like the S&P 500. That's not a market, okay? That's a centrally managed and manipulated Wall Street casino in which you can buy a chip if you want, and you can make money. Don't get me wrong, you can make money that way, but understand it's not a market. They've got us myopically focused on this one sliver of quote unquote the market, which is the S&P 500, which is not a market. It's an artificially created derivative of a derivative. It's an artificially created metric that like all this whole universe of so-called investments is all tied to this one metric. Why would you want your entire livelihood tied to this one metric where you have to hope and pray it goes up and you have no control over it? None. Neither does your financial advisor. He can't control the S&P 500, can he?
No. And, and we've, in the other episodes, look it up. I mean, I've talked about the Ernst & Young report until I'm blue in the face. Ernst & Young has proven that an investment-only portfolio cannot be a portfolio that has some cash value life insurance, some type of annuity, and an investment part of it, right? It can't be done. They've proven it.
And it really hurts me to see what it does to these people. I mean, I do get angry, but I hope people see that my anger comes from love. When you love something, you love someone, you care about someone, you get angry when you see them taken advantage of. And so I'm not, it comes from love. It really hurts me to see people like this having their dignity robbed from them by Wall Street, right? And I'm trying to give people a different alternative where, among other things, you actually have control. So I love your question, Peter. Like, whose plan is this? Whose plan is this? So please, people, whatever you decide, even if you want to just put your money in mutual funds and retirement accounts, just please take responsibility for your own decisions and understand that you cannot outsource that decision-making responsibility to anybody else. I want you to educate yourself and be responsible and not outsource that to somebody else, right? If you want to have someone advise you and assist you, good, you should, but you have to take responsibility for your own decisions.
Right. I always ask the question, what's your plan? Not my plan. It's not your financial advisor's plan. It's your plan. What do you want your legacy to be, right? Do you want your retirement income to be, have a, probable outcome or a predictable outcome? Some stuff like that, right? I mean,
right. And all this money in the market, as one person said, it's an accumulation strategy, but it's not a distribution strategy, right? So most people, when they climb the what's the tallest mountain in the world? Mount Everest.
Mount Everest. Yep.
Yeah. They don't actually die on the ascent. Most of them who die, they die on the descent.
Yep.
Right. And so you'll hear this a lot in circles where it's not accumulating the nest egg that's the difficult part. It's making it last throughout retirement. Okay. And most of the conventional strategies, I disagree with you, Peter. They're not traditional. There's nothing traditional about them. They're modern. They're conventional.
And you know what? I will, you are correct. And what I mean by that, you are absolutely correct. And I appreciate that. But so they are, okay, in the last 50 years.
Yeah. And what they are strategies at best for accumulation, not for distribution. And that's a problem, right? Because that's really what matters is once you get to retirement, not how big is your nest egg, but how much safe, reliable, passive income can you generate? Look, it's very simple, folks. As Robert Kiyosaki says, it's not about return on investment. It's about cash flow. When you're looking at your personal economy, whether you're 25 or 75, You don't ask yourself, what return on investment did I get this month? No, you ask yourself, how much money do I have coming in and how much money do I have going out? Where is my money flowing? Is money flowing to me on net, or is money flowing away from me on net? Okay. So, yeah. Okay, so let's go a little further. All right, here we go. This is going to be a struggle for me to get through this. Okay. Whole life insurance is a poor investment vehicle for the 60,000th time. It's not
Don't
an
even,
investment. He's the one saying that. I'm not saying it's
no,
an investment vehicle. He's the one who's saying that. Okay. It's not an
not an
investment.
investment.
Okay.
And by the way, I don't know if you saw
It'd
my,
be like, just to give, hold on, just to give an analogy, it's like, hey, Peter, I've got a vehicle for you. You pay me $5 and I'm going to guarantee you I'll pay you $100,000 a year from now until the day you die. What return on investment am I getting? That's a poor return on investment. Wait a minute. I'm paying you, right? Like, you cannot apply this return on investment framework to everything. It only works with the Wall Street controlled investment vehicles, because if they're going to lock your money up in jail, they have to promise you something in return. They're not giving you income, so they have to promise you some kind of return on investment. But again, it's not about return on investment. It's about cash flow. So sorry, go ahead, Peter.
no, I was just going to say, I don't know if you saw my LinkedIn post from the other day, but I was railing on, not going to say the company, but this agent that sent an email to me because I'm a member of that company. He was literally calling a fixed annuity. He was saying that in competitive investment returns, and he was referring to a fixed annuity. Okay, this is an insurance agent doing this. So I just want to say, I'm not always the financial advisors, but a fixed annuity. Now, people consider CDs and similar savings vehicles as investments, but per the letter of the insurance world or laws, an insurance product is guaranteed. It is not an investment. I'm very careful to, I just wanted to mention that. I kind of hate the way we've gotten with that. Is we're comparing apples to oranges, but then, I like I said, I see it on both sides and it just drives me nuts.
Yeah, to be as charitable as I possibly can to the financial advisor, it's a straw man argument. I never said this was an investment vehicle or an investment strategy of any kind. He's the one saying that. It is certainly not an investment at all. Okay, now he says, per the illustrations. So my client shared with him an illustration that I shared with my client, which of course was not a final solution. It was just a sample, right? Here we go. So this gets to the liquid. You need 10 years of premium contributions before you realize a positive return on the accumulated cash value. Here we go again. When do I get my cash on cash return? Missing the whole point, right? That's the first thing they look at, because again, he's looking at it as if it's an investment vehicle, which it is not. Okay, it's all about cash flow, and it's not about return on investment. And again, he's criticizing whole life.
I'm just curious. What do you remember? Just roughly, I think it would be good for people to know. What was the dollar amount and the face amount, the annual premium and the face amount that you'd quoted that guy?
I don't recall offhand, and I don't want to mention specific numbers.
I was just curious about the premium and face. But I will tell you that.
But yeah, the face amount was a lot more than the premium amount. Yes, if that's
well, yeah. I mean, just like I know I did one last year. Let's just say it was like 2 mil bought 3 mil. 2 mil of premium over 10 years was going to buy a $3 million face amount year one. So that's why I just wanted to mention that. People are going to say, well, a 75-year-old. This one I'm talking about was like a 70-year-old. Okay.
The ratio was a lot more favorable than that, actually.
Okay.
So what he paid in, he got more than 10 times, probably at least 12 times the amount he paid in death benefit. Remember, it's a survivorship policy. And again, this is not the final policy design, right? So the financial advisor, again, is going off on things that are completely irrelevant, because everything he's talking about is completely adjustable and customizable. If I wanted to adjust it to make our cash on cash return happen faster, I can do it. It's
Right.
totally flexible, right? It's totally flexible. He's treating this like it's a final solution when it's not, right? And he's latching on to things that are concrete because he cannot think conceptually, right? It's sort of like looking at a house and starting to criticize the house without ever trying to understand, why did we buy the house in the first place? Is it a place to live in? Is it rental property? Is it a fix and flip? Right? Like, is it a vacation home? Like, what are we using it for? Right? And I just want to point out, nowhere, not even once in his email, has he even addressed, let alone criticized, the infinite banking concept. He's going off in the weeds on whole life insurance, which he confuses with universal life insurance and other things. He has not even addressed the infinite banking concept, right? Where does he address your need for capital? Where does he address your need to control the banking function in your life? Where does he address opportunity cost? He doesn't address any of that. So he just latches on to concrete things and he tries to reduce everything to return on investment, right?
Yeah.
Which, by the way, again, a 1%, let's say it's a 1% return on investment. That's still superior to what you're getting in the market. You know why? That 1% is guaranteed, right? What's the guaranteed rate in the market? If we're going to do an apples to apples comparison, you would have to look at the guaranteed rate on both sides. And whole life insurance crushes the guaranteed rate in the market every single time.
Yeah, and I mean, you factor in the leverage death benefit with the living benefits on top of it. It's a Swiss Army knife.
Oh, here we go. Okay, now here's what he wrote. Okay, we can't guarantee market returns in the investment portfolio, but historically, we expect average annualized returns of between 5 to 7%. It's interesting that he puts between 5 to 7%. That's what he's comfortable putting in writing, but that's not what he told the client.
Right.
What he told the client was better than 8.5%, right? So again, it's this subtle form of psychological manipulation, right? So he'll put that in writing, I guess, so he can cover his bases, but he won't put in writing 10, 12, 14%, whatever he's promising the client, right?
Well, let's remember something, Logan. Every single thing that he sends in an email to the client is journaled. It's backed up. I can tell you that because my emails are backed up too, my investment emails. Okay. So yeah, he's not going to put 8, 10, 12% in an email because that thing is up in email purgatory forever.
But what he will say, again, this is the subtle psychological manipulation, is he'll say, but the S&P 500 is average 10%. So he's not directly saying you'll get 10%, but he's basically saying that, right? And to your point, Peter, when he mentioned in the meeting that, hey, you can cover for a long-term care event by having money in the market. Your advice to me was ask him to give you that in writing. And of course I did. And of course I never got anything. He's not going to put that in writing, but he'll say it. But he'll say it.
Of course.
Right. Right. Okay. I know you have doubts about your longevity, but statistically speaking, you and your wife are likely to live 14 to 20 more years per IRS life expectancy tables. At that point, the return isn't very appealing. Further, these products are designed as an actuarial bet that favors the policy carrier. That's ridiculous. But anyway, we'd much rather see you retain control of the investment decision making and regulate your equity exposure, taxes, and fees appropriately. So what he's really saying is, I'd rather see me retain control of your investment decision making. I'm holding everything on. I'm holding on to everything with my white knuckled grip, and I will never let you decide anything for your own.
Yeah. Yeah. Buy, the 3 lives of Wall Street, right? Buy and hold. Higher the risk, higher the reward, and it's just a paper loss, baby.
Who's making the decisions?
Yeah.
Who has control? Right.
Now, this guy is, I have to give the guy or girl, whoever it is, I have to give him kudos because, like you said, the psychological warfare that they're waging is absolutely epic.
It's effective. It's 100% effective. And I agree with something that another infinite banking guy said on his YouTube channel, that they really don't have like an investment or financial framework that they're using. It's really all marketing. It's really all sales and marketing tactics, right? I've seen a lot of the so-called frameworks that are out there, and it's really just sales collateral when you dig under it. Now, some people like myself and people who are effective at helping their clients do use real, actual frameworks. But the standard so-called frameworks, they're really just sales collateral. And it's really, like you said, and like I said, it's really a not so subtle form of psychological manipulation is really what it is.
This one's
It's
really
sales
bad.
collateral. It's marketing collateral. It is not an actual framework. It's not a disciplined financial approach. And part of the reason you can see that is because how little time they spend educating their clients on why are we doing these things, right? So when my clients sign up for the infinite banking concept, no financial advisor is going to be able to dissuade them from it, right? Because they've been educated on the principles involved, why we're doing this, right? And they're therefore not going to fall for a lot of the marketing and the sales material that's out there because they've been educated. Whereas this client, to your point, Peter, the reason why he's talking to me is because he does have some doubts, clearly, about what's going on.
His
right?
needs haven't been met. He's being abused. I mean, my gosh.
It's very sad, and again, my heart breaks for people like this because it's just sad. And hey, the thing is, it's not too late, despite the fact that he's 75 years old. If you look at the plan I had started putting together, right, between a reverse mortgage and a properly structured survivorship whole life policy, all of a sudden, you've really helped yourself, right? You've freed up a lot of liquidity. You've got guarantees in place. You have death benefit protection, or long-term care protection, and income, right, and so on, that you have in place, right? But unfortunately, it seems like a lot of people out there, once their financial advisor gets hold of them, they are always waiting for their financial advisor to give them permission to do something. So when they say, let me discuss this with my financial advisor, unfortunately, what they're really saying is, I've abdicated my decision-making responsibility. Because it is tough to make decisions, I'll be honest, right? It's hard to make decisions, especially when there's so much conflicting information out there. And people want some authority figure to kind of take that off their hands, right? And so unfortunately, they're left in the position of, really, it's not your money anymore. It's your financial advisor's money, and he's making all the decisions for you, which is not the relationship I have with my clients.
No, absolutely. It is.
Yeah, so we've gone through this a little bit faster than the normal, because at this point it's just rehashing points we've been over 1,000 times, right?
Right.
We'll just go a little bit.
Yeah,
a
keep on
little
going.
bit
Keep on
further.
going more.
Yeah. You don't need to overcomplicate liquidity by paying premiums into a whole life policy to, quote, serve as your own banker, unquote. Okay, well, first of all, as your financial advisor is pointing out, the amount of liquidity you have in your investment portfolio is zero. Zero. So clearly we do need to overcomplicate things, because you're not getting any liquidity from your current strategy. It's all trapped in this Wall Street jail under the white knuckled grip of the financial powers that be, and they're promising you some ephemeral return on investment, which may materialize or may not, right? And you have no guarantees, right? And of course, when he says liquidity, when we talk about becoming your own banker, obviously there's a lot more to it than just liquidity. But we're actually simplifying things, believe it or not. We're not overcomplicating it. We're actually simplifying his scenario.
By the way, and I'm sure you've told me this before. Did you ever actually look at the portfolio? Was there any bonds in that portfolio?
I didn't look at the portfolio. Again, it's a waste of my time, right? First of all, I'm not pretending to be an investment expert.
I was
right?
just curious.
But also, I mean, yeah, I have to be judicious with my time. So at the end of the day, I know what the guaranteed rate of return is in that portfolio. That I know. I can tell you what that is. Negative 100%. That's the worst case scenario. Negative 100%. You look at a whole life policy, the worst case scenario is a positive return, right? Whatever that is, right?
Yeah. I only asked because, that's, let's just say this guy, I'm guessing it's somewhere between 80-20 and 60-40 is the stocks to bonds ratio. At least, hopefully it's closer to 60-40. And that's where, of course, we, I would say at the very least, let's look at reallocating that ineffective and inefficient bond portfolio, and reallocating that. And I forgot if I had asked you that previously, and that's fine. It's just
he did cover it in the email a little bit, but to me, it's like, look, this is not part of I'm not suggesting whole life insurance is part of a portfolio. This is not part of your portfolio. This is your cash flow management tool, right? So when he talks about, well, your cash comes in, but you don't get all of it out immediately, you don't have all of it available to you immediately, right? It's like, no, actually what we're doing is we're recovering money that would be leaving your personal economy. So what's happening is today, when the client spends money, that money permanently leaves his personal economy. Okay. By flowing those expenses through your whole life policy, what happens is now you're able to recover at least a portion of those expenses. So I'm just making these numbers up. So if he's saying, oh, over the course of the first 5 years, you pay in $200,000, but you only have $150,000 in cash value at the end of those 5 years. See, that's a negative return. It's not what's happening. What's happening is that was $200,000 that you were going to spend over 5 years. And $200,000 would have permanently left your personal economy.
Right.
Now what we've done is we've recaptured $150,000 worth of that, right? So whatever number we have in the whole life policy, it's a return, it's a recycling of money that would have permanently left your personal economy. Okay. And by the way, if you happen to die, now that death benefit pays out. If you have a long-term care event, you can advance yourself a portion of that death benefit. Right. So again, he's again doing the same thing, viewing it as an investment vehicle, which it is not. Right.
Yeah,
Not
it's a broken record. So just a broken record, you know?
Yep. And he cannot think conceptually. He's getting lost in numbers and mechanics.
I honestly, by the way, after listening to this email, he may actually conceptually know this better than what, but he's purposely not going, and it's worked apparently for him, right? He might be smarter than we think on this, and I could be totally wrong. Maybe he is that dumb, but with the manipulation that's going on with this guy, he might even be smarter than what we even think.
Yeah, I think he is. It's just it's the way he's formed. It's the training that he's received. He's locked into this, and it becomes and his profit incentives are aligned with this particular philosophy, if you can call it that. So yeah, it's hard to know. I think that I'm not saying he's not an intelligent person, but I'm saying that his training teaches him to myopically view everything as a quote unquote investment, which, by the way, these aren't real investments. Okay. If you want to know if you have a real investment, this is something I cover in one of my videos where it says, how much money do you have in the bank? That's the title of the video. Watch that, where I make the distinction between investing and speculating. Okay. If you want to know if you have a real investment, ask yourself a question. How much do your investments pay you? Okay. If you put your money into a vehicle and you're hoping for some return on investment, you are speculating. And there's nothing wrong with speculating, by the way. You can make money that way. Just understand the difference and position size appropriately. You shouldn't be speculating with all your money, and know that's not saving for retirement. That's speculating. And it's okay to do that in a disciplined manner with a reasonable position size. Okay. Rich people do not put their money into mutual funds and 401ks. Rich people invest in two things, generally speaking. Okay. Businesses and real estate, because that provides you with income. That provides you with cash flow, and you have control over it. When you buy real estate, when you start a business or become a partner in a business, you have a high degree of control over that asset. When you put your money into a mutual fund, you really don't have any control over how that mutual fund performs, right? And it gives you no cash flow, right?
I mean, let's face it, we live in a messed up world. I mean, wasn't it last Saturday where 1,500 Palestinians stormed the Israeli border? And I don't want to go into that whole thing, but only reason I mention that is because the world can go to heck really fast, right?
Mm-hmm.
And if the market goes down, go down a lot, how's your liquidity now? Mm-hmm. Right? You don't have liquidity.
Right.
I mean,
and whole life insurance is a two-dimensional asset, right? So like we talked about before, your money in the market doesn't give you liquidity in the way that whole life insurance does, right? Because with whole life insurance, you can take out a policy loan, which allows you to use the cash value in the policy while your cash value keeps earning for you. Absolutely. So it's a two-dimensional asset. So he's just looking myopically focused on how much cash value do you have, right? That's like looking at a piece of cash flowing real estate and just looking at what's the total value of that property and how does that go up over time. And it might be 3 to 5%, not very exciting. Okay. But a real estate investor is making a ton of money off of that because of all the ways that he can leverage it and all the cash flow he's getting out of it. All right. So looking at whole life insurance, just myopically focused on the cash value and how does that grow over time, misses the whole point, right? If you apply that same logic to just about any good business or real estate rental property, you have to conclude it's a bad investment because the return, quote unquote, is not very good, right?
Right. Absolutely. Yeah. And by the way, I want to mention something real quick. So, and I don't know if you saw any of this, Logan, but my sales coach, along some of the, he spoke at this conference, and so did Tom Hegna and a bunch of other people. It was in Beirut, Lebanon. Okay. Kid you not, this was last week, this conference. It was a life insurance conference. And they spoke at it and everything was fine. And then the whole thing with Israel happened, right? Now, if you people don't know about Lebanon, all right, pretty much it doesn't have a government anymore. There's all the banks, by the way, if you drive through Beirut, are boarded up. All right. I was told a story about how a guy had a couple $100,000 in the Bank of Lebanon or something, and the rumor started spreading that things were not being good at the bank, and he went to get all of his money out. They notified him that he could get $400 a month out. Okay, now it's amazing to me in a way. This is my optimistic side of me. Those guys in a country that practically has no government, they're having a life insurance conference. The life insurance industry is still fairly healthy in that country. Why is that? Now, maybe the life insurance companies themselves are not in Lebanon, but those people in Lebanon are putting money into cash value life insurance policies because the banks, they don't trust, but they know that money is always going to be there in their cash value life insurance. But I was told that yesterday or day before. It blew my mind. That's why I love this industry so much.
Yeah, who bailed out the banks during the Great Depression?
Yeah.
It was the mutually held life insurance companies. The other thing I wanted to mention too is with this particular financial advisor and with the philosophy he goes by, they always speak in terms of probabilities. Like you'll talk about worst case scenarios and they'll say, oh, that's not likely. Well, hold on. It is possible, right? I mean, your home might burn down. It's not likely. Is that a reason not to buy homeowners insurance? Because hey, it's not likely, right?
3% chance, and yet
Yeah,
everybody has it.
But my point is, in every single aspect of our financial lives, we would never accept a probability. We want certainty. When you get hired by a full-time employer, do they say it's pretty likely we'll pay you your scenario, your salary? That's pretty likely we'll pay you your salary, but we may not. A week here, a week there, we may miss it, but it's pretty likely we'll pay you, right? We wouldn't accept that, right? We wouldn't say it's pretty unlikely my home is going to burn down, so I don't need homeowners insurance, right? It's unlikely. We would not accept that. Yet somehow Wall Street has brainwashed us into thinking in terms of probability when it comes to a really important thing, saving for retirement, supposedly, right? We're supposed to accept probabilities where, yeah, it's pretty likely the market will go up at a healthy rate. And of course, when they say the market, they don't really mean an actual market. They mean the S&P 500. Yeah, it's pretty likely, right? Well, maybe it is, but we would not accept that logic in any other aspect of our financial lives, right? We want certainty in our financial lives. We do not want probability, because most of us would conclude the same reason why we buy homeowners insurance. It's just not worth the risk. It's not worth the risk. Same thing here. So if you want to speculate with some of your money, that's fine. Speculating is fine. Believe me, I have no problem with speculating. You can make a lot of money speculating if you know what you're doing, but you got to position size appropriately. That is not the same as saving for retirement, right? You've got to only use money that you can afford to lose is the basic rule of thumb when you're speculating. You are not saving for retirement when you put your money into vehicles that have risk, right? So again, in every aspect of our financial lives, we want certainty, except apparently when it comes to saving for retirement or investing or whatever you want to call it, right?
Yeah, absolutely. No better way to say it. It's just a diversified portfolio is not just stocks and bonds, ladies and gentlemen. And even if we're not even talking about that we're talking about putting the whole life as part of your portfolio, just please, if you ever hear somebody say, yeah, I have a diversified portfolio of stocks and bonds, just punch that advisor right in the face, because that is not diverse. Just punch him. I mean, now punch him lightly, okay? Lightly. Don't hurt him.
And by the way, yeah, like we just said before, there are really good financial advisors out there. So again,
absolutely.
I'm not casting aspersions in general. I know some great ones. I've worked with them. Like I'm all for partnering with other professionals when they have their clients' best interests at heart. And so in my experience has been the financial advisors who work with high net worth tend to be some of the better ones. And they view whole life insurance in a very positive light, because high net worth individuals have more whole life insurance than anybody else. So I don't think those guys became high net worth by being stupid with their money. So maybe there's something there. But I also just wanted to mention again, I personally, with relevant to this case, I'm not talking about whole life insurance. I'm talking about the infinite banking concept. So you, in that Ernst & Young report, you're talking about whole life insurance just as whole life insurance, and that's fine. But we're talking about the infinite banking concept related to this case. So it's the percentage you put into your whole life policy is not the right question. The question is, how much of your income flows through a bank account today? That's how much you want flowing through your private bank tomorrow, right? Because either JP Morgan Chase profits from managing your cash flow, or you profit from managing your cash flow, okay? We are not putting money into a specially designed whole life policy. No, we're not locking it up in jail like it's an investment and hoping for a return. No, we are running our cash flow through our specially designed whole life insurance policy, the same way you run your money through a checking account today without even thinking about it. The difference is when you run your money through a checking account, there's nothing left in the checking account when you withdraw money, right? That money just is gone. Whereas with specially designed whole life insurance, because of the unique way we can tap the money, that money is still earning for us inside the policy, even while we're using it. So again, it's a two-dimensional asset, not a one-dimensional asset.
Absolutely. So, I like to mention the Ernst & Young because at least gives people a percentage, I think, in a way, because like I said, maybe it's not 30%, right? I mean, maybe your cash flow, what you're putting into your bank, maybe is 50, 60, 70, 80%, right?
Well, it's just, yeah, no, the thing is, again, there's infinite banking concept and there's whole life insurance, two different things, because there are multiple ways you can look at and use whole life insurance. So that Ernst & Young report is fine. It's just they're looking at it differently. They're not talking about the infinite banking concept.
Right. No.
They're looking at whole life insurance as a savings account and a legacy planning tool, which is perfectly fine. That's a perfectly legitimate way to use whole life insurance. That's why, again, what the financial advisor is doing is so dishonest and disingenuous. And I think he's just doing it because he's ignorant, where he's looking at it in isolation and he's looking at it as if it's an investment vehicle when that's not what it is, right?
Right.
I could, like I said before, if you, Peter, present me with a whole life insurance policy and say, Logan, is this a good policy? I'll say, I don't know. It depends. What are you trying to use it for? Right. Situate it for me in your overall financial strategy. And depending on what your goals are, the same whole life insurance policy might be terrible for one person. It might be great for another person, right? The way I'm going to structure a policy for estate tax avoidance for a high net worth person is very different from the way I'm going to structure a policy for infinite banking, but both are good policies, right? Again, to get back to the real estate analogy, it's like looking at a house and asking me, is this a good house or a bad house? Well, I don't know. What are you planning to use it for, right? The answer to any good question is, it depends.
Right. I mean, it would be like, listen, I like guns and I like all the different calibers and stuff. If you came up to me, Logan, and said, hey, is a 308 a good caliber? I might say, well, what are you going to use it for? Are you going to target practice? Are you going to deer hunt? Are you going to hunt water buffalo? Are you going to hunt squirrels? It's kind of the same concept. I don't know, right? I mean, 308's a good gun, but maybe it's not for what, if you're squirrel hunting with a 308, that's not good. there won't be any squirrel left, right? So
Yeah, yeah. And so again, just to close us off, to repeat what I've said from the beginning, this financial advisor has not even addressed the infinite banking concept. He clearly has no clue what it is, and he's getting lost in the weeds of whole life insurance, and he's viewing it as an investment vehicle, which it is not, right? So it's like me looking at a great piece of real estate and trying to trash it because I don't understand what that real estate was meant for in the first place.
right, absolutely. All right, Logan. Well, thank you so much for this. We went a little bit. I kind of think it was good though, the way we did that. And do we have one more
We
part
have
of
more.
this? Or?
We're getting towards the end. This one went a little faster because now he's just kind of repeating himself, and we've been over all this.
Oh.
But it's just it's
How
so
many more you think we got there? One,
probably 2 more episodes.
2 more. So that's going to be what, 7 total?
Yeah, yeah. But I mean, again,
seven's a good number, so I like that.
I hope people's hearts are bleeding the way mine is for this poor 75-year-old who has all his money trapped in the market and is waiting for his financial advisor to give him permission to do something that's actually in his own interests.
By the way, I just thought of something. I think your heart should really bleed for this guy when you see what the economic lookout, the economic research we pay for. 2024 is going to be ugly economic wise, probably in this country. So, yeah, I wonder if his advisor has told him about that one. But anyways, we'll talk about that maybe next episode. All right, guys. Logan, thank you so much. I really enjoyed this. So everyone we're doing this actually on Friday, October 13th. You have a Friday the 13th. I love the 13th. This is Our Lady of Fatima and all that good stuff. So everyone have a wonderful weekend. Thanks again, Logan, for doing this, and God bless, Godspeed.
Thanks, everyone. Goodbye.